We move forward now to another very interesting session for our Treasury colleagues. I'm going to ask Mrs. Elina Chronopoulou to come on stage and discuss about transfer pricing for the Treasury function.
Hi, everyone. Thank you for being here. Thank you, Eliana, for the introduction. Today, we will talk about another interesting hot topic for Treasury function. It has to do with transfer pricing. So in this session, we will navigate a little bit the landscape of transfer pricing for Treasury. We will share some recent experience about audit challenges and some recent developments in legislation. And we will also discuss about how Treasury can have a role in mitigating risk that has to do with transfer pricing. So before we move on, let me put some context in our discussion. Transfer pricing is a tax legislation that's driven by international tax incentives, and the purpose is to avoid shifting profits between jurisdictions. Rules for transfer pricing are applicable in more than 100 countries, and although local implementation of these rules may differ between jurisdictions, in essence, we all follow the same principles and the same policies as stipulated in the OECD guidelines, which is the Bible for transfer pricing. So, what's required for transfer pricing? In short, it is required for companies to evaluate but also document in a proper transfer pricing file, a detailed report, that the pricing terms of the transactions between entities of the same group are in the same terms as it would be if concluded between independent parties. And therefore, there is no intention to overprice or underprice these transactions for purposes of shifting profits between either entities or between jurisdictions. In other words, what we usually call in transfer pricing that the terms are at arm's length. Practically, this means that although transactions between independent parties are considered de facto to be at arm's length, transactions between related parties need not only to be at arm's length, but also to be evidenced to be at arm's length. And this is applicable to all intercompany transactions, therefore applicable also to the main transactions that involve the Treasury function. The analysis for the evidence that the arm's length principle is applied is actually relevant to the definition of the arm's length principle per se. So what we need to do in order to evidence is to evidence that the pricing terms of the transactions between related parties are the same as the terms that independent parties would negotiate and agree in similar transactions under similar circumstances. And those two elements, similar transactions and similar circumstances, are actually the core concept of transfer pricing. So it requires to fully understand the terms and conditions of the intercompany transaction and what actually drives pricing, what are the factors that drive pricing, and then find market data from independent parties to validate that the terms are in similar transactions are the same. And although it may be the answer to the question of whether the spread in intercompany loan set at 2% instead of a 3% or 1% could be self-explanatory based on experience, finding the publicly available data to support this may be a challenge, especially in cases where we have niche intercompany transactions where market data are very scarce or independent parties would not be willing to enter in a similar transaction. To put an extra layer on this challenge, we need to also keep in mind that this analysis performed, regardless of how complex or not it is, it's not intended to be reviewed by a fellow treasurer or a finance person, but it will be reviewed by the tax authorities that sometimes lack technical knowledge, resources, or even the willingness to understand the methodology that's applied. The OECD guidelines have been very silent on the issue of financial transactions for many years. It takes only to consider that the OECD, the first release of the OECD guidelines was in 1995, and it took them up to 2018 to release the first non-consensus draft of the financial of the guidelines for financial transactions. And then it took them another 2 whole years to make it final and reach consensus. This final draft has been included in the guidelines in the Bible for transfer pricing, the revised version of 2022. So for the last couple of years, we have detailed guidance from OECD, at least for major transactions that relate to Treasury. Now, diving deeper into what the guidelines provide, the new guidelines are much aligned to the overall concept of the transfer pricing rules as those developed after the BEPS era. So a substance over form approach is considered in this case as well, where broader commercial and financial relations and questions are raised, and substance is also to be considered. For example, would independent parties enter into this kind of transaction in the first place? Does the borrower has the financial capacity to actually assume a loan and repay a loan? Is the lender of the funds able and capable of assessing, monitoring, and managing the risk that entails this loan transaction? And if not, is there any other entity of the group that silently undertakes the risks and will undertake the cost in case the risk materializes? What are the options realistically available to all parties of the transaction? What is the borrower's perspective? What is the lender's perspective? Those are questions that are raised in the new guidelines in relation to the delineation, the actual understanding of the terms and conditions of the transaction that we are trying to understand and test for transfer pricing purposes. In the same spirit, and without getting into too much technical detail, the guidelines provided also directions about key aspects that need to be considered and methodology that needs to be applied for pricing or testing the pricing of different financial transactions that relate to Treasury, loan pricing, cash poolings, guarantees, hedging, what is very common in the Treasury function. Admittedly, this new guidance was very much welcomed by the transfer pricing community because we expected that it will contribute to the overall consistency and therefore mitigate in time the risks that relate to this kind of transaction. But where do we currently stand in terms of controversy and challenge? As part of the EY's Global Financial Transactions Transfer Pricing Network, we conducted a survey in different countries. And what this slide tries to reflect is a visual summary of the results and conclusions of different countries in 18 different jurisdictions. So in the left side, we have different technical aspects that are usually challenged in terms of financial transactions and transfer pricing. And for each technical aspect, we also have a bar that represents countries and challenges. So in the middle of the bar, there is a white dividing line. What's on the left side of the dividing line is cases where this specific technical factor has been challenged by the tax authorities of the countries reflected in the left side. On the right side of this dividing bar, it's cases where it has been challenged and it is also litigated. It's before the court. So I admit it's not very intuitive representation at this point, and that's very easy to read, but we can draw some conclusions and some key observations from this slide. And first of all, it is clear that there is transfer pricing controversy in many different technical areas of the transactions. The second observation is that we see controversy across the globe in many different countries. And the third observation would be that some countries are not very shy in litigating transfer pricing disputes. So, interestingly, if I had shown you this same survey from 3 or 4 years before, the results would be much, much different. We would not see the same diversity. We would not see too many countries involved in transfer pricing challenges for financial transactions. There can be many explanations for this. One explanation is that the tax authorities are becoming more experienced and more technically knowledgeable. The OECD guidelines also taught the tax authorities how to approach these kind of transactions. And another explanation could be that the OECD guidelines for financial transactions, although in the right direction, failed so far to bring the consistency and the mitigation of risk that was expected. For one, because there are different opinions and diverse interpretation at local level of the guidelines. And because even if the local interpretation is aligned with the guidelines, it takes time to fully implement within the OECD countries. And this transition period creates a lot of risk for controversy and a lot of uncertainty. Indicative of this last point, how the OECD guidelines are interpreted and the risk and challenge that arises because of the transition period is what we will discuss later on the recent developments on an area that's very commonly challenged that has to do with credit rating and implicit guarantee. It's one of the key challenges in transfer pricing. So, before we go to the developments, just to put some context on this, the OECD guidelines were very vocal on the matter of credit rating and implicit guarantee. They stressed the importance of credit rating for assessing interest rates and borrowing risk. And they also took a position on the methodology to be followed for assessing the creditworthiness of an entity, which pretty much resembles the methodology that's also applied by the major credit rating agencies, S&P, Moody's, Fitch, etc. So in my view, it's also very relevant to the S&P group rating methodology. And in this context, the implicit support of the group was also factored in. And having said that, now we have the German case, where recently, in March 2024, Germany introduced new interest deduction limitation rules. And what they say is that the interest expense in case of intercompany financing can only be deducted if specific tests are met, a cash flow test and a business purpose test. But what's interesting and relevant to what we discuss right now is that interest is limited to the interest rate that would derive from the group credit rating, and not the standalone credit rating of the company. So what the German tax authorities actually say is that they presume de facto that any subsidiary in Germany enjoys full support from the group and therefore has been assigned with the same credit rating as the group. And this is the norm for Germany. We are still to see how this plays out because it's very recent legislation. But for now, it is expected that it will create a lot of an increase in documentation requirements because there is a way out, but the country needs to prepare an additional analysis to actually validate that the credit rating of the subsidiary being different than the credit rating of the group is arm's length. So we expect this to create significant increase in documentation requirements and controversy. On the opposite side, we have the UK and the US legislative developments, where in both cases, the government took the position that the transfer pricing rules need to be revisited in order to fully align with the OECD guidelines. In the UK, there's a reform of the transfer pricing legislation to also take into consideration implicit support, whereas in the US, we have a position from the IRS, although it's not described in the local legislation, that they consider implicit support as being relevant to the estimation of the credit rating. And although there may be a need for legislative changes in order to this to legally be effectuated, companies will still need to assess what was the methodology so far for any outstanding loans and see whether pricing policies will need to be adjusted. It is a change in the mind of the government, so they need to see how this plays out in their own intercompany affairs. And now that I hope I've given you a glimpse of the current transfer pricing landscape and the risks and opportunities that this involves, the next question, I think, would be how to navigate through this and how to manage and mitigate the risk. Transfer pricing is not intended to disrupt the business operations and therefore the Treasury operations and the Treasury decisions. But it is here to stay, and it does provide some constraints that need to be taken into consideration if we actually want Treasury transactions to be as much efficient as possible and maximize the growth for the whole group overall. So it is quite important to assess and evaluate cases where there's a potential risk and to identify opportunities and ways to mitigate deficiencies, or at least to be aware of these kind of exposures when decision is made. Another good point in risk mitigation would be to make sure that we align the Treasury policies for financing with transfer pricing guidelines and design and implement policies that already take into consideration, at least on an overall level, the exposure that transfer pricing could have, and create policies that are practical, efficient, and easy to implement. We need to remember that it's not only about pricing, it's also about evidencing that the pricing is at arm's length. Consistent approach and consistent implementation of these policies is very much important in risk mitigation. We need to keep in mind that tax authorities, the new trend is for tax authorities to perform joint audits and to exchange information among them. So applying a different policy in one jurisdiction compared to another could create additional risks and should be avoided. But we also need to frequently revisit those policies on a group level, both to take into consideration business needs that are changing from time to time, but also legislative provisions that may change. And lastly, for cases where risk identified is considered important or maybe not avoidable, exploring proactive controversy options such as APAs or rulings with the tax authorities could be an effective way to mitigate risk. But in the way that things are evolving, and both in the Treasury aspect, but also in the tax aspect, close collaboration of tax and Treasury are key in order to make sure that we maximize benefit for the group. So, key takeaways. Transfer pricing rules, what we need to remember, transfer pricing rules are applicable to the full spectrum of the transfer pricing of the Treasury functions that relate to intercompany, to subsidiaries and other entities of the group. There is a global trend of increased transfer pricing controversy on financial transactions. And managing transfer pricing risk requires close collaboration of the Treasury and the tax function and a robust TP risk management framework. Thank you.